Hi everyone. So welcome to the stream today. Really excited for having you on the third session in our series of the IFRS Masterclass. In case you missed the part one, which was on Monday, and the part two, which was on Wednesday, you can check the podcast on the channel. Titled the IFRS Masterclass, and you'll be able to watch the entire episode so that you'll be able to get understanding on what we are doing and the various things that we are looking at in this masterclass. And today we want to continue with our discussion focusing on still IAS 21 effect of changes in exchange rate. Then we're going to be bringing in some thoughts from other accounting standards like IAS 10 events after the reporting period and IAS 2 inventories. We may also share some thoughts on IFRS 15 revenue from contracts with customers. So welcome to the stream. Really excited. See some of you guys joining. Give us a thumbs up on the video. And then if there are any questions you have, something you want me to share my thought on, don't hesitate to put it in the chat for me or the comment section for me. I will be excited to answer your questions for you. Let me position my slide well here. So let me bring up my screen quickly and then let's get excited into our discussion today. All right. So we were on a question in respect of IAS 21, effect of changes in exchange rate. Just a quick recap. We mentioned that the IAS 21 governs transactions that are denominated or treatment of transactions that are denominated in a foreign currency. And so it is important that in every question we identify the functional currency of the entity. And so we give a couple of guidelines that we need to follow to help us to understand what the functional currency of the entity is. But most importantly, we should be able to know how to deal with monetary items and then non-monetary items. One of the things that we shared our thoughts on was that when we are dealing with monetary items, they are going to be translated at the reporting date using the exchange rate at the reporting date, and then any translation gain or loss will be recognized in the P&L account. However, if we are dealing with monetary items, at the reporting date, we are going to be accounting for those non-monetary items in accordance with in accordance with their relevant accounting standards. So if it's an asset that we bought, property, plant, and equipment, then we'll apply IAS 16. If it is an investment property, then we'll apply IAS 40. If it's an inventory, then we'll apply IAS 2. So it is important we understand monetary items and then non-monetary items in that particular case. So let me bring up my slide because there was another question that we wanted to share our thoughts on here. So there we go. This is another question that we want to really look at and see what we can do in this particular case. So let's see the question we have here for this discussion first. So we go. Give me a sec. Let me see. Okay. So the requirement here is pretty simple. It says, explain and show how this event will be reported in the financial statement of Delta for the year ended 30th September 2016. How these will be expressed in the financial statement of Delta for the year ended 30th September 2016. So like we mentioned, it is important to always understand the year ended 30th September 2016 because that will guide us on the various treatment that we need to do. So let's go then to the question and see what we need to do. Delta is an entity which prepares financial statements to 30th September each year. Now, we've been told that already about the year ended of the company, so it's not something that we are new to or we have to be thinking about generally. The financial statement for the year ended 30th September 2016 are shortly to be authorized for issue. Okay. The following events are relevant to these financial statements. All right, so let's see what we have in respect of this particular scenario here. On 1st September 2016, now remember 1st September 2016 will be when? 1st September 2016 will be just the beginning of the last month for the year ended under review. Delta sold a product to customer X. Customer X is based in a country whose currency is the florin. And Delta has a large number of customers in that country to whom Delta sells similar products. The invoice price of the product was 500,000 florin. Okay, so let's get the idea and really understand what is going on here. So our company, Delta, okay, that's our company, is selling to a customer somewhere, customer X, and the currency of that particular country where the customer is the florin. Is the florin. Now, let's continue to read. The terms of the sales gave the customer the right to return the product at any time in the 2 months period ending 31st October 2016. So I want you to understand what is going on here. The sales was done on 1st September 2016, but there is that 2 months grace period. So 31st October 2016, the customer can return the goods that they have bought. So it's a goods that the customer has the right to return. So it's a goods that has been sold, but we got to be careful here. So let's go back to the question. Now, the sales price is $500,000. So that is the invoice price, 500,000 florins. 500,000 florins. Is it florins or florin? Okay, florins. Whatever that is. So that is the idea about that. Now, so the question we then ask ourselves is, how much revenue do we recognize in respect of this? Now, so this is where you got to be careful about this. Under IFRS 15, revenue from contract with customers, revenue is recognized when a performance obligation is what? Satisfied. So as per IFRS 15 guideline, since we have sold the goods to the customer, we are supposed to recognize revenue. But the customer has the right to return the goods if they have not sold it. So you got to understand that immediately we see a transaction like that, sales with a right to return, it means that there are two things we have to do. Number one, we need to recognize the revenue, and then we have to also recognize a refund liability. Stay with me carefully. We have to recognize revenue and recognize a refund liability. The refund liability will be based on the best estimate of the entity on the probability of the goods being returned by the customer. So this is based on the best estimate of the entity on the probability of the goods being returned by the customer. Stay with me carefully, because this is very important. So we have sold goods to a customer, but embedded in the deal is that the customer can return the goods 2 months' time. So we don't recognize the entire value, that is 500,000 florins, in our books as revenue. Because it is a sale with a right to return, there are two components in there. There is a revenue there and there is a refund liability there. Very important. So the sales value of 500,000 florins must be splitted into these two components. We need to recognize revenue component of it and then recognize the refund liability of it as well. Are you getting the treatment? Very important. Very important. So let's go back to the question then. On 1st September 2016, Delta estimated that there was 22% chance the product will be returned during the 2 months period. So on the date that they made the sales, the entity estimated that there is a 22% chance that the goods will be returned. Remember, I told you that the refund liability is based on the best estimate of the entity on the probability of the goods being returned by the customer. So at the date of the sales, which is the 1st September 2016, the entity has estimated that there is a 22% chance that the customer will return the goods. But let's continue to read. The product had not been returned to Delta by 15th of October 2016. Stay with me carefully. Our year ended is 30th September. So September, October. So it means that 2 weeks after the year end, the date on which financial statements are authorized for publication, the goods have still not been returned yet. But you got to be careful because the customer has a right to return the goods in 2 months' time. So at 15th of October, where we are authorizing the financial statement for publication, the customer still has about 15 days to return the goods if he so wishes. So you got to be careful here. Let's continue to read. On 15th October 2016, the directors estimated that there was an 8% chance the product will be returned before 31st October 2016. Oh. So what is this? This is events after the reporting period in accordance with IAS 10. And it's an adjusting event because it's an estimate. As at the reporting date, we have not concluded on the possibility of the goods being returned or not by the customer. So the day on which financial statements are being authorized for publication, the management have now estimated that there is an 8% chance that the goods will be returned. And so that is an adjusting event that will affect the way we have to recognize the revenue in our financial statements. What does that mean? It means that the invoice value of 500,000 florins, we have to recognize revenue and recognize the refund liability. So the amount recognizable as a refund liability will be the 8% of the invoice, right? And then the revenue will be 92% of the invoice. Does that make sense? You get the idea here? It goes back to the principle we explained here about when there is a sales with the right to return option. So that is the idea there. Again, the 8% thing is happening after the reporting date. So it's an event after the reporting period in accordance with IAS 10. But it is giving us further information about an event that was existing prior to the reporting date. Hence, it's an adjusting event. So really, when it comes to this particular invoice, this is how we're going to be accounting for it. 92% will be going to revenue. 8% of that will go to financial refund liability. So let's see how we can then put the pieces together. The directors of Delta considered that most reliable method of measuring the prices for this transaction was to estimate any variable consideration using probability, that is expected value. Then we are given the exchange rate to use. So let's see what happens then. So what's going to happen is that on the date of the transaction, 2 florins equals $1. But because remember, the customer is in a country whose currency is the florin. So it means our company, Delta, their functional currency is going to be the US dollar, the US dollars. Okay, that will be their functional currency. So the date of the transaction, $1 is equal to 2 florins. So let's go. Now that we have done the workflow, let's go to Delta. And then let's bring in the initial recognition. So the amount to be recognized as revenue will be 92% of the 500,000 florins. Let's punch that out. 0.92, 500,000. That's 460,000 florins. Oh, I think I'm enjoying writing the zeros. 460,000 florins. But we are not done because company Delta is a dollar denominated. That's their functional currency. So we convert that into dollars using the exchange rate at the date of the transaction, which is 1st September, 2 florins to a dollar. So 1st September 2016. So if 2 florins equals $1, then 460,000 florins will be equal to how much? So what do? We divide. So we get a revenue recognizable in dollars. So that's going to be 460,000 divided by 2. And that is going to give us $230,000. Okay? $230,000. So the revenue to be recognized in respect of this transaction is $230,000. But remember we said the proceeds must be split between revenue and refund liability. So we get a refund liability. And that's going to be 8% of the 500,000 florins. And we'll divide that by 2, okay, so that we can get our answer coming up because the exchange rate is 2, so we work it out straight. 0.08 by 500,000 divided by 2, and I'm getting $20,000. So this is how we split the revenue. But remember, we are not done because if I ask you what is the journal entry, we didn't sell this for cash. If the customer has a right to return, then it looks like this is what? A credit sales. So really, we have to recognize debtors. So trade receivables will be the entire 500,000. So the 500,000 florins divided by 2 will give us $250,000. Will give us the $250,000. So journal entry on initial measurement, if you want to. Maybe let's take this to the next slide. So I don't have to squeeze my right up there. Will be to debit trade receivables with the entire figure of $250,000. All right. Then we will credit revenue with the $230,000. Then the balancing figure is what we are crediting to refund liability, which was the $20,000. Do you see it? So that is the initial measurement. Again, know the principle. Anytime there is sales and the customer has a right to return the goods, the principle is then that sales figure contains 2 components, the revenue component and then the refund liability component. So that is the initial measurement. That's our initial measurement. I see some of you guys joining. This is the IFRS Masterclass. Give us a thumbs up on the video when you join. It really helps us a lot. And then if there is any question, any clarity you want also, put it in the comment section for me or the chat box. I'll be excited to answer all your questions and share the link so that we can really reach a lot of students watching the video and getting access to the channel together. So give us a thumbs up. It really, really helps us a lot on the video because that's the only way YouTube can push the video so we can reach many students just like yourself and help a lot of students so that we can all become successful. Now, Subsequent measurement. At the reporting date, which is the 30th September 2016, the debt is still outstanding, isn't it? So remember, the trade receivables is a monetary item. So what do? We have to translate that at the reporting date. So subsequent measurement, what's happening at the reporting date? That is 30th September 2016. So because the trade receivables is a monetary item, we have to translate it at the reporting date. Now remember, the person still owe us 500,000 florins. But at 30th September, what is the exchange rate? The exchange rate at 30th September now is 2.1 to a dollar. 2.1 to a dollar. So let's go. $2.1 florins to a dollar. So the person still owes us 500,000 florins. So how much will it be? So at the reporting date, trade receivables that will go on the face of the statement of financial position will be equal to 500,000 divided by 2.1. And so in dollars, what are we going to have in dollars? 500,000 divided by 2.1. Ooh, I'm getting something. 238,095. $238,095. That is the trade receivables at the reporting date. Stay with me. If you compare that to the figure at the beginning, what's happening? Because at the beginning, when the transaction occurred, the person is owing us $250, was to owe us $250. But at the end of the year, now the person owes us only $238.95. And so how much the person owes us has reduced because their currency has appreciated in value. And so that is going to be an exchange loss that will be recognized in the P&L account. Sounds good? That's going to be an exchange loss. So the 250,000 minus 238 and 95, what we got? 250,000 minus 238 and 95. Ooh, I'm getting 11,905, and that will go to the profit or loss account. That will go to the profit or loss account. Why is it a loss? Because trade receivables is an asset. Reduction in an asset is an expenses. You don't need a miracle for that. All right? Reduction in an asset is an expenses. So the person owed us 250,000. At the reporting date, their currency has appreciated in value, so they now owe us only 238.95. So there is a reduction in value of 11,905. That's the first thing we do. Second, now the revenue figure will be recognized in our financial statement, so nothing will happen. But still, at the reporting date, 30th September 2016, the refund liability has to also be recognized on the face of the statement of financial position under current asset. Sorry, under current liability. So what do? We have to translate the refund liability also at the reporting date so that we get a foreign exchange gain or loss, which will be brought in the P&L account. So refund liability that will go on the face of the statement of financial position will be, remember it's 8%, still 500,000 divided by 2.1 now, because at the reporting date, the exchange rate is now 2.1 to a dollar. So let's punch that out. Let's get the refund liability at the reporting date. 0.08, 500,000 divided by 2.1 and I'm getting 19,000 and maybe 48 approximately. So this is now the refund liability we have to recognize on the statement of financial position under current liability, because the person has 2 weeks to go, or we have 2 weeks to go, so it will be under current liability. But if you compare this figure to the initial figure we recognized, what has happened? The refund liability has also what? Reduced. Now, why are we doing this conversion? Because the refund liability is also a monetary item, right? That's why we are translating. Now, reduction in a liability is what? A gain. Okay, so we thought we owe them $20,000, but now at the reporting date we owe them only 19,048. So reduction in a liability is a gain. So that will give us an exchange gain that will be recognized in the P&L account. And so that will be the difference between the 20,000 and then 19 and 48. And that will give us an exchange gain of 19 and 48 minus 20,000. That's like, what the heck? $952. $952. Okay, so I'm seeing some questions. Let's see if I can pick them quickly. Maybe they relate to what we are doing, then I can quickly answer them here. So let's see. So we have Debbie said, happy to be here. First time on the live stream. Downloaded almost all the videos on your channel, but never attended real-time class. You are extremely good. Please keep up the good work. Thank you, Debbie. We will keep it up. Who is this? All-knowing. Greetings, sir. Greetings, all-knowing. Why? Are you God? Yahusha Adam said, great lecture. Thank you, Yahusha. Amnesty Junior is with it. Thumbs up in the chat. What else do we have? Nasa Siri Felix said, yes, I like it. Here enjoying in Uganda. Okay, that's great to hear. More Magona said, beautiful work, Nhyira. Jonah watching from Uganda. Okay, thanks very much. And I see some of you guys joining. You are welcome. This is the IFRS Masterclass, the third installment in the series. In case you missed the part 1, the part 2, you can check the channel and you look at the podcast on the channel. The IFRS Masterclass on the channel, it's a podcast, and so you can watch the entire episodes there in relation to the series that we are doing on this whole discussion there. And also give us a thumbs up on the video, guys. Give us some thumbs up on the video and also share it, okay? So we can reach as many students as possible on the stream. ICAG said, sorry if I don't mention your name right, okay? You forgive me, right? So, good evening, sir. It's a pleasure joining you for the first time. Great to hear from you guys. Thanks. Many people are joining us for the first time on the stream. It's really nice to hear from you guys. Thanks for taking the time and joining us on the stream. Okay, so let me bring back my screen. Thought there was some questions for me, but I can bring up my slide now. There we go. All right. So now that we finished with the workings, we can now extract our financial statement for the entity. But that's the workflow generally. That's the workflow generally. So delta, statement of profit or loss. For the year ended 30th September 2016. Now it's an extract, so just a few things will be in. We want to let the examiner know that. So we slash in the currency sign. First, we're going to bring the revenue, which we worked for earlier. the initial measurement bit, got a revenue of 230,000. Okay, so that comes there, 230,000 for the revenue in that case. Then we bring in the other items that must come in the P&L account. The first one will be the exchange loss on the trade receivables, then the exchange gain on the refund liability. So exchange loss on trade receivables. Then we bring in the exchange gain on the refund liability. So this one was 952 and this one was 11905. That was a loss, so we put that in brackets. I don't know, my camera is finding it hard to focus, but I think we are good. So this is our statement of profit or loss account in respect of this particular scenario. Then we go to the position, also an extract. So statement of financial position for the same year ended, but an extract as well. And then we bring it up for the period there. And we will have under current liability, current assets first. Under current assets, we'll bring in the trade receivables. And the translated closing figure, which was how much? 238.95. That is what will come. That's the current assets. Then under current liabilities, we'll bring in the refund liability. And we'll bring in the new figure, which is 19.48. This is the answer to the question. This is the answer to the question. Any questions? Any questions? Any questions? Any questions? So just going back to the slide again here for my explanation, Delta sold goods to a customer. The customer has a 2-month option to return the goods. In other words, within 2 months, the customer has to return the goods. And we said that, yes, in accordance with IFRS 15, once a performance obligation is satisfied, we have to recognize revenue, isn't it? But anytime the company sells with that option given to the customer to return the goods, then the invoice price contains 2 components or has 2 elements. That is the revenue element or the revenue component, and then a refund liability. And we mentioned that the refund liability will be based on the best estimate of the entity in accordance with the probability that the probability of the the customer returning the goods. So we did the calculation. There is an 8% probability from the question, and that was after the reporting date. So it becomes an adjusting event in accordance with IAS 10. And so there is an 8% chance. So refund liability will be 8% on the invoice value, and 92% will be the revenue item in that case. Then we do our initial recognition. Then on subsequent measurement, we have to also translate the monetary items, which is the trade receivables, and then the refund liability, so that any exchange gain or loss will be recognized in the P&L accounts. This is the idea about this particular question here. Any other questions for me? Let's see. I'm seeing some other comments coming up. Let's see if I can pick them real quick. Lucky upon with a thumbs up in the chat. Thank you. Ibrahim Kondewa Condewa said, just coming. I hope I'm not late. Okay, you are late a little bit, but you can watch the playback after the stream. Yeah, good evening. Nsikak said, joining from Nigeria. Okay. And next, Enes said, good job, Nhyira. I don't know that name. If I try to pronounce it, I'll say something else. Sorry about that. Nathaniel said, thanks, Emmanuel. Nathaniel, okay. I don't know. Stephanie Botry said, first time joining your live stream also. I salute you. Stephanie, thanks for joining us. Hope you're loving it. For Livy, Cynthia said, great work. Thank you, for Livy. Cynthia, I hope I'm able to pronounce that well. You have always been helpful. God bless you. That's Francis Abugri. Amen. God bless you too for being part of the stream. Joe Nana said, great tuition, Nhyira. Thank you, Joe Nana. Then Stephanie said, please, where exactly do you position the exchange profit or loss in the income statement? Technically, it will come under other income, Stephanie. In the P&L accounts, it could be under other income. Okay, so after your gross profits under other income, it could be there. Okay, so here, under other income. Under other income. Alternatively, sometimes if it is a cost, sometimes it could also be added to the cost of sales. So because there is no specific guideline in the IAS 21 as to where exactly the entity can recognize it. So sometimes an entity may treat it, if it is a loss, it may treat it as part of the cost of sales. If it's a gain, they may include it as part of other income. Other times you will see these things adjusted for under administration expenses. But the best place to be at is just after other income. Then you can bring them there. So Stephanie, if you ask us to where exactly we put these figures, the best place will be other income. But like I said, you may see in some books where it is placed under, how do we call it? Thought I was having my slide on. It is being placed under cost of sales, adjusted in cost of sales, or adjusted in operating expenses. They are all right. They are all right. But to be on the safer side, just put them after other income. That is after gross profit. You bring them in and you'll be good. Okay? You'll be good. All right. Let's see if I have other questions coming up, because I got a couple of comments coming up. I see some of you guys joining. You are welcome to the stream today. Really excited for having you on the stream. Forgive me, I think, unfortunately, when I started the stream, I put my camera on an autofocus, and it is just trying to focus on things it's not supposed to focus on. So that's why you are seeing that coming up, but no worries. Rachel, did I get that right? I don't know. Rahel or Rachel? Which one? I think this is Rahel. I don't know though, but whatever. Kwanzaa said, sir, please, what happened to the revenue in the translation and the 12%? I don't get a context of your question though, but the revenue is the revenue, right? So we just recognize it. Like we stated here, it will be on the face of the profit or loss like that for the initial measurement we did. Okay. And then you are asking what happened to the 12%. Okay. Was there any 12% in the question? There was no 12%. Oh. Kwanzaa, let me know where you are getting the 12% situation from. It's rather 22%. And that was the estimate they did at the date that they made the sales. Okay? At the date they made the sale, there was a 22% chance that the person will return the goods. But when we read further, before the financial statements are authorized for, how do we call it? Before the financial statements are authorized for publication, the management said that, oh, now there is just an 8% chance that the goods will be returned. The reason why it has fallen like that is that on 1st September, that was the date they sold it. But at 15th October, we are left with only 2 weeks to go. So if the person has kept the goods for 1 month, 2 weeks, then the probability that the person will return the goods now will be lower. That is why the 8% adjustment that comes after the reporting date, in accordance with IAS 10, becomes an adjusting event that we consider. So Rahel Kwanzaa, I don't know if that is Rahel or Rachel, whatever the heck I'm pronouncing right now, but Kwanzaa, I hope that you get a concept there in that particular case. Come on now, find my face. Okay. Nathaniel said, I'm watching from Zimbabwe. Said, I'm doing CTA in Zimbabwe. Okay. Thanks for joining us on the stream today. Then I am seeing another chat. Let's see. Patrick Ajay said, good evening, Nhyira. I want to say thank you. I was able to pass FR by watching your online videos, but I want to know if the topic is applicable to level 3 ICAG. Everything in corporate financial reporting is examinable in corporate reporting. That's one thing you need to understand. Everything. Okay? Is examinable. Everything. So from IAS 16 to IAS whatever, everything is examinable here. Does that make sense, Patrick? So you can't pick and choose because, you know, in level 3 corporate reporting, there are only 3 exclusive standards there, if I can say that. And that is IAS 19, employee benefit, IFRS 2, share-based payment, and then IFRS 8, segment reporting or operating segment. These are the only 3 exclusive standards in level 3. So all the standards that you learned in level 2 corporate reporting are examinable, and the examiner does it every semester, because in the exam hall we're going to see a question on non-current assets, and all the non-current asset standards are in financial reporting. So Patrick, you need everything here to be able to excel in the corporate reporting as well. So you don't have to put everything or whatever you learned aside. But the thing is that in corporate reporting, some things are going to be raised a little bit. So for instance, in financial reporting, we did tax, but the coverage of IAS 12, income tax, in financial reporting is a little bit lower than its coverage in corporate reporting. Because when you're doing IFRS 2 share-based payment, there's a tax implication that will come there. Okay, the same thing happens to financial instruments. Financial instrument is in financial reporting, but when you get to corporate reporting, we will do the same financial instrument, but there is another level of financial instrument treatment that we will bring up, and that is the issue about hedge accounting. So yes, everything in the financial reporting is necessary, it's needed, and we're going to be adding it up a little bit when we get to corporate reporting. So really, everything is relevant. Okay, everything is relevant. Stephanie said, okay, thank you. All right, you're welcome. Let me know any other question. Kwanzaa, I explained your question, the question that you asked about the revenue and the 12% issue. If you're still on the stream, let me know that whether that makes sense for you and whether that was what you were looking at generally. So let me bring back my presentation slide here. Okay, I'm seeing another question coming up. I think let me pick that up also quickly. Foley V said, why don't we translate the revenue like we did for the trade receivables? Okay. Cynthia, there is no need for us to translate the revenue because the revenue is not a financial position item. It's a P&L item. It is only the items that are outstanding, which we have to take to the statement of financial position, when they are monetary item, that needs retranslation. You get that? That's the treatment. So the revenue at the date of the transaction, we have translated, we add it to the revenue, it ends there. It's in the P&L account. There is no revenue that will be recognized on the face of the statement of financial position. So the reason why we are doing the retranslation for the trade payables and the refund, the trade receivables and the refund liability is because we have to get the figure that must be reported on the face of the statement of financial position at the reporting date. And hence, we have to retranslate. But the revenue, we don't do anything to it. So, Cynthia, let me know if that is also clear for you in relation to that. And then any other questions, let me know quickly. Put it in the chat for me. Going to be taking all of your questions. Okay. So that is the question about it. So you realize that in this question, although primarily we are focusing on IAS 21 effects of changes in exchange rate, there is an IFRS 15 breadth in it, revenue from contract with customers, and there is an IAS 10 implication about that, event after the reporting period. So although the date of the transaction is 22%, after the reporting date, the estimate now is 8%. And that is an event after the reporting period. It's an adjusting event, so we have to include that in our workflow. That is the idea about that. Okay. So just let me go back so that if some people will take a screenshot. So the discussion starts from here in that case, and then we break it down to this place, and then we did the workings for the initial recognition and subsequent measurement also on this slide here, and then finally we bring in the refund liability. Then we extract the financial statement. We extract the financial statement. Okay. So let me pull up the last question here. There's another question here. Another interesting one. It says, explain and show how this event will be reported in the financial statement of Delta for the year ended 31st March 2018. Okay, so you can actually try your hands on this one. All right, try your hands on it and see how you will do. Okay, so you try your hands on it and see how you will do with that. When you try your hands on it, you can send it to us. We will check it for you in that case via WhatsApp, and you can see the scroller below the screen. The WhatsApp line, it's displayed there, 0501149296, and we'll be able to help you there. So that is a question that you can try your hands on to see if really you understand this IAS 21 and its related standards. Okay, to see if you understand IAS 21 and its related standard. So that is just one aspect of, the IAS 21. That's just one aspect of the IAS 21. Now, the rule will apply to if we buy an asset. It will apply to if we buy inventories. It will apply to whatever type of treatment that we want to make in our financial statement when it comes to dealing with these items. The rules will still apply. Okay? The rules will still apply. All right. So I'm going to be wrapping up around here today. And then, God willing, Monday, I'll be, coming your way as we continue with the discussion here. But let me take a few questions before I get excited. Please allow a screenshot of the question. Okay. So let's see if I can bring the question back up. So this is the question, and that is from Dibo Ajedebi. Ajedeji. I don't know. Forgive me if I wrongly pronounce your name or whatever. So this is the question. This is the trial question, what you can try your hands on. Okay, this is a trial question. And then this was the question we solved in class. This was what we solved a moment ago. So remember, the examiner will give you a lot of exchange rates, and you have to know which of the information given is actually relevant for you in respect of the question that you are ultimately solving. Okay? And that's how the accounting standard is like. So really, the key thing is to understand the principle. Once you understand the principles, you expose yourself to questions. And the more questions you solve, the better your understanding of the various aspects of the principles come. The better your understanding is going to be. And so because you will get more perspective on how the various items would have to be treated when given in a question. So I'm going to be wrapping up around here today. And God willing, Monday, I'll be coming your way, same time as we continue with the discussion. And remember, if you're preparing for the ICA November 2023 exam, we are in the 6th week and we have ended the 6th week. So we have less than 6 more weeks to go for the examination. So really, if you are writing the exam, you got to raise the game. You have to be studying. You have to make time to really work hard so you can ultimately pass the examination at the end of the day. Now, we've got a couple of questions that we've received a couple of questions as to whether, it is right to start studying now to sit for the November 2023 examination. And there are 2 ways to approach that particular question generally. Number 1 is that if you have the capacity, you have the time, and you are willing to dedicate yourself, then you can register and start studying. But remember, you have a backlog of 6 sessions that you would have to watch before you continue with what is happening for the next 6 weeks. So it's a challenging ground generally that you need to understand well. But largely, if you don't have the capacity, then you can just postpone and then prepare for the March 2024 examination. Okay, because we've been receiving questions in respect of that particular need. Because you see, the way the ICA exam is now, it's getting better. If you are lazy and you don't have brains, you fail the exam. So you have to work hard. You have to really put in the work, really put in the effort if you want to pass the exam. So my take on that is examine yourself. For instance, if you enroll in our courses, we have the lectures available that you can watch the playback for the last 6 weeks and other videos. Can you watch these videos and continue with the main class? If the answer is yes, I have the time available, I have the resources available, fine. If not, chop Christmas and let's deal with you in Easter in March 2024 in that case. Okay, so just analyze. And if you have not started learning and you're not serious already, please be serious. Okay, it's important. Cynthia said, what happens if the 8% not an adjusting event? I don't understand your comment, Cynthia, because really it's an adjusting event. It's an information given to us after the reporting date, but relates to something that was existing at the reporting date. But if you are asking the question in the context of IAS 10, that we are dealing with non-adjusting events, the non-adjusting events by default will be disclosed on the face of the statement of financial position. Did I say that? Will be disclosed on the face of the statement of financial position. Will be disclosed rather in the notes to the financial statement. I have to catch myself because I made a wrong statement. Okay, so generally for non-adjusting events, they will be disclosed in the notes to the financial statement. But in the context of this question, that 8% is giving us information about something that existed at the reporting date. Hence, it becomes an adjusting event. That is why we will use the 8% for our workflow and not the 22% at the date of the transaction. And not the 22% at the date of the transaction. Okay. Nathaniel said, Cynthia, you would then debit rural credit. What's that? What are you preaching? I don't know what you're saying now. All right. So that is it about that. So generally, we're going to wrap up around here today. And like I said, God willing, Monday, we will continue with the discussion. I don't know. My camera is just struggling to focus at this point. But I'm wrapping up, so no problem about that. In that case. Okay. So I wrap up here today, and God willing, Monday we will continue with the discussion. Like I said, Nathaniel, I don't know what you are trying to say. Please, what you are saying, I don't know what you are saying. It's wrong. So don't say that. Yao Tre said hi. Hello, Yao. Welcome to the stream. Okay, so that's it about that. And that is how the masterclass is going to run. So you realize that this week in the section 1, we focused on the overall standards and the way you learn the standards together. Then in the session 2, we did IAS 21 and solved the question. And today, still IAS 21, bringing on board events after the reporting period and IFRS 15 and how they are knitted together generally. On Monday, I'm going to be coming your way, same time, 4:30 p.m. as we continue with the masterclass. So stay safe, have a great weekend, and I'll catch you next week as we continue with the masterclass. Remember, you can check the podcast on the channel. Okay, on the YouTube tab, you will see podcast, and under the podcast, we have the IFRS masterclass podcast. You can check that whole video there because everything there, or you can check the whole podcast. There are, I think, 18 videos there. Everything there relates to the standards that you need to understand to be able to pass the examination. So check out the whole playlist or the whole podcast on the channel because it's going to help you a lot. Thank you very much. And for the people who gave us thumbs up on the video and who shared the video, really appreciate it. God bless you and have a great weekend. Bye-bye.